Understanding market psychology, fear and greed is less about labeling emotions and more about recognizing the invisible forces that move price long before any indicator reacts. Markets are not driven by logic in the short term. They are driven by collective human behavior, and that behavior oscillates endlessly between two primal states. Fear contracts decision-making greed, expands it, and price becomes the visible trace of this emotional tug-of-war. Trading literature that endures does not treat fear and greed as flaws to eliminate, but as constants to be understood, anticipated, and respected. Because every market movement is at its core a story about how people react under uncertainty. Fear is the older and more powerful of the two. It emerges first in markets because loss is felt more intensely than gain. When fear dominates, traders seek safety. Liquidity dries up, and price moves faster than logic can justify. Fear compresses time. Decisions that once took days are made in minutes. Stops are hit not because levels were wrong, but because emotion overwhelmed patience. Trading psychology texts often note that fear rarely announces itself as panic at the beginning. It starts quietly, as hesitation early exits reduced size or the urge to just be safe. By the time panic selling appears, fear has already been shaping behavior for much longer than most traders realize. Greed, by contrast, expands perception. It convinces traders that opportunity is abundant and urgency is justified. When greed takes hold, risk feels smaller than it actually is. Winning trades are held longer than planned, losing trades are rationalized, and position size quietly increases. Greed does not feel dangerous in the moment. It feels like confidence. This is why it is so destructive. Trading literature consistently warns that greed disguises itself as conviction, making it harder to detect than fear. By the time traders recognize it, they are often already overexposed. What makes market psychology so challenging is that fear and greed do not operate independently. They feed each other in cycles. Greed pushes price beyond reasonable value. Fear then pulls it back violently. These cycles repeat across all time frames, from intraday fluctuations to multi-year bubbles and crashes. Understanding this rhythm allows traders to stop interpreting every move as new information and start seeing it as emotional momentum playing out. Price does not move because everyone suddenly learned something new. It moves because perception shifted collectively, often without conscious awareness. One of the most important insights from trading psychology literature is that fear and greed are not problems to be solved, but signals to be read. Extreme fear often appears near the end of selling waves when most participants who wanted to sell already have. Extreme greed often appears near the end of buying waves when optimism has become consensus. This does not mean traders should fade every emotional extreme blindly, but it does mean that emotion itself contains information. Markets rarely turn when participants feel balanced. They turn when emotion becomes one-sided. On an individual level, fear and greed show up long before they are visible on the chart. Fear shows up as rule-breaking in the direction of safety. Greed shows up as rule-breaking in the direction of expansion. Both result in the same outcome: inconsistency. The trader who understands market psychology learns to watch their own behavior as a proxy for crowd behavior. When you feel unusually uncomfortable entering a trade that fits your plan, fear may already be widespread. When you feel unusually confident ignoring risk because this one feels obvious, greed may already be in control. Your internal state is not separate from the market. It is a micro-expression of it. Trading literature often emphasizes that managing fear and greed does not mean suppressing emotion. Suppression creates blind spots. Awareness creates choice. Traders who stay consistent learn to pause when emotion spikes, not to eliminate it, but to prevent it from driving execution. They build systems that slow them down when greed accelerates and support them when fear paralyzes. This design-based approach is far more effective than relying on willpower in the heat of the moment. Over time, understanding market psychology also changes how traders interpret news and narratives. Headlines rarely move markets on their own. They amplify existing emotion. In fearful markets, bad news feels catastrophic. In greedy markets, the same news is ignored or rationalized. This asymmetry reveals that emotion precedes justification, not the other way around. Traders who recognize this stop chasing explanations and start observing reactions. How the market responds to information matters far more than the information itself. Ultimately, fear and greed are not enemies of trading. They are the raw material from which opportunity and risk are formed. Markets exist because participants feel these emotions and act on them. The goal is not to rise above fear and greed, but to see them clearly enough that they no longer control behavior unconsciously. And it is precisely at this point, when emotion is recognized as a constant companion rather than an occasional intruder, that a trader begins to read the market not just as price movement, but as collective psychology unfolding in real time, a process that continues endlessly as long as humans participate in markets and bring with them the same ancient instincts to protect, to desire to rush and to hesitate. And it is within this understanding that the deeper work of trading truly begins and continues forward without yet fully coming to rest. Because once fear and greed are seen clearly, the trader's task shifts from reacting to emotion to positioning around it. As this awareness deepens, traders begin to notice that fear and greed have signatures. Fear often produces sharp, fast moves, accompanied by expanding volatility and shrinking patience. Candles elongate, spreads widen, and reactions become exaggerated. Greed, by contrast, often produces smooth, persistent trends, where pullbacks are shallow and confidence feels justified. Recognizing these signatures allows traders to adjust expectations. In fearful markets, precision matters less than protection. In greedy markets, patience matters more than aggression. The same strategy applied blindly across both states will feel broken, not because it is wrong, but because it is emotionally misaligned with the environment. At a more advanced level, traders learn to design rules that anticipate emotional extremes rather than respond to them. Position sizing is reduced when volatility expands rapidly. Trade frequency is lowered when markets become euphoric and obvious. Stops are respected more strictly when fear accelerates. These adjustments are not discretionary guesses. They are pre-planned responses to emotional conditions that have repeated throughout market history. Trading literature consistently emphasizes that the best traders are not those who feel less emotion, but those who plan for it in advance. There is also a personal dimension to this work that cannot be avoided. Understanding fear and greed in the market inevitably reveals fear and greed within oneself. Traders who ignore this parallel struggle endlessly. Those who embrace it gain a powerful feedback mechanism. When you feel an unusual urge to act, to increase size, or to abandon patience, it is often a clue that the broader market is experiencing a similar pull. Your internal state becomes a sensor, not a weakness. This does not mean trading based on emotion, but being informed by its presence. Over time, this relationship with market psychology produces a calmer form of confidence. Not the confidence that comes from believing you are right, but the confidence that comes from knowing how you tend to behave under pressure and having systems that protect you when emotion intensifies. Losses still occur. Drawdowns still happen. What changes is the reaction. Fear no longer triggers panic. Greed no longer demands expansion. Both are acknowledged, noted, and contained. This containment is what allows consistency to emerge in an environment defined by uncertainty. Another subtle shift occurs in how traders interpret success. In emotionally charged markets, profits can feel intoxicating. In quiet markets, patience can feel unrewarded. Traders who understand market psychology learn to measure success not by emotional satisfaction, but by alignment. Was the trade taken in the right emotional environment? Was risk adjusted appropriately? Was restraint exercised when emotion was one-sided? These questions replace the constant need for excitement with a steadier sense of control. Ultimately, fear and greed are not phases you graduate from. They are cycles you learn to navigate. Markets will always alternate between optimism and pessimism, between expansion and contraction. Traders who last are those who stop trying to outsmart these forces and instead learn to move with awareness inside them. They recognize when emotion is building, when it is peaking, and when it is exhausting itself. This recognition does not guarantee perfect timing, but it improves positioning and protects capital when the crowd loses balance. And so the true understanding of market psychology is not about predicting tops or bottoms, but about seeing the emotional weather clearly enough to decide whether to travel to slow down or to stay still. Fear and greed become less like enemies and more like signals on a long road, warning of curves ahead or stretches where speed feels tempting but danger is near. When a trader learns to read these signs without reacting impulsively to them, trading shifts from an emotional struggle into a disciplined observation of human behavior expressed through price, a practice that continues to deepen as long as markets exist and participants bring with them the same timeless emotions that have always driven them.